Thank you, everyone, for joining us, and welcome to today's session on Intro to Finance. This topic is part of our nonprofit financial series, which hopefully should help you improve your financial management processes in a practical way. And my name is Liz Tang. I use the pronoun she, her, and I'm the education coordinator for IntegralOrg. I'll be around to host and monitor the chat. And without further ado, I guess we'll get right into it. Go into our land acknowledgement. So we do like to acknowledge that the land that we live and do work in is called Alberta, and what we call Alberta is the traditional and ancestral territory of many peoples, presently subject to treaties 4, 6, 7, 8, and 10, namely the Blackfoot Confederacy, the Kainai, Piikani, Siksika, the Dene, the Cree, Saulteaux, Nakota Sioux, and Stoney Nakoda, and the Tsuut'ina Nation and Métis people of Alberta. And this includes the Métis settlements and the 6 regions of the Métis Nation of Alberta within the historical Northwest Métis homeland. And we'd like to acknowledge that we respect the histories and languages and cultures of the diverse First Nations, Métis, Inuit, and all First Peoples of Canada who have lived in and cared for these lands. And so we're grateful for the traditional knowledge keepers and elders who are still with us today and those who have gone before us. And I am very happy to introduce today's facilitator. Just going to put her on the stage. Today's facilitator is Stella Penner, and she has decades of experience providing financial reporting and governance support to charities and nonprofits. Previously, Stella has held various roles in professional development and as a full-time instructor in financial and management accounting, audit, finance, as well as organizational design and analysis at universities and colleges in Edmonton and Calgary. And she also has executive experience as the prior CEO of CGA Alberta. So thank you everyone for joining us today, and Stella, take it away.
Thanks, Liz. So welcome aboard, everybody. I want to just reiterate one of the comments that Liz made at the beginning about the sort of purpose and level of this course. This is just a 1-hour session. We may go a little bit over with a Q&A, but clearly in an hour, we're not going to be going into any particular topic in a great deal of depth. What our purpose is to give you a fairly wide spectrum, and there's always a trade-off between depth and breadth. So we want to give you sort of a bit of a laundry list of some of the controls that a typical charity or nonprofit would be looking to have in place and implement for best practices as far as financial controls are concerned. We're going to be focusing on financial controls primarily. And so we'll look at how the roles of the different parties in the financial system may affect the kind of controls that you have or don't have in place, and make sure that everybody knows what lane they're operating in, and that you establish common understanding of roles and responsibilities. Then we'll look briefly at what kind of financial information does the board need in order to fulfill its role in the whole financial system. We'll look briefly at the purpose of what do we mean when we say internal control, focusing, of course, as you can tell from the topic and title of the course, on financial controls. And then we'll look at set examples of key financial controls. And of course, the examples we give may or may not be applicable to your particular organization. We will have time at the end for a bit of Q&A, but there's not time in 1 hour to address specific questions in a great deal of detail. But if you have general questions about anything that I've covered, we'll take that later. And then I'll have a little bit of a tag on to talk about the integration and the role of your budget process in maintaining control over your financial system. So that's kind of where we're going today, and some of the areas of financial controls in a nonprofit that will give you a chance to see, sort of do a mental checklist as we go through the hour and say, oh yeah, we've got that in place. Oh yeah, we're clear on that. Or that's something we may need to do further investigation on. That's kind of the purpose of today, is for you to do a really high level assessment of your own organization. So one of the really critical things in any control system, whether you're talking about a nonprofit, about a business, about a family, if things are going to run smoothly and things not fall between the cracks and people not step on each other's toes, what's really important is that each party in any kind of relationship knows what their role is and accordingly what their responsibilities are. And so I'm going to be discussing this slide and what the typical roles are that are assigned to different parties in a nonprofit organization. And again, I want to stress that in a large, complex organization, there will be more players in the system than what I've described here. And in a very small organization with few or no employees, there will be fewer roles. But in broad terms, what are the players that have a role in keeping your finances sorted out? So the first group in a nonprofit with the ultimate responsibility for finances is the board of directors. So the board of directors is accountable to the organization's members. And I realize that in a lot of nonprofits, the members and the board may be the same group of people, but those are two very different roles, and it's important for the board and everybody concerned to understand which hat they're wearing, depending on what actions they're taking. But the board has a responsibility. If you could think of the board as if they were trustees. So funders, donors, members provide financial resources to the organization, and the board is the steward of those resources. And so they have a trust obligation to the contributors to use that money wisely and to not squander it and to not use it for purposes other than what the organization exists to achieve. And so the board has fiduciary responsibilities. By that's what we mean basically by that term. They're trustees, is they have responsibilities that any trustee would have when they're taking care of someone's estate or someone else's money. And then stewardship in that context refers to wise and prudent care of the resources. So you have this trust obligation, and then within that, how do you want to do your job as a board? You want to do it wisely and make prudent decisions. Some of the other responsibilities of the board is to plan ahead, to determine what the priorities are for the organization. Any charity and not any nonprofit has certain finite resources. You don't have an infinite pool of money coming in. You have only so much money, only so much staff, only so much volunteer time available. And so it's the board's job to decide, in applying and using those limited resources, what are our priorities and what direction do we want to move this organization, and which direction do we move first and how fast? So that would be the board's responsibility to set that high level direction. Another responsibility of boards that is often done intuitively and not spelled out explicitly is risk assessment. So the board has a responsibility to be aware of what kind of risks they face. And often this takes the form or is part of a process that in the past was called SWOT, looking at strengths, weaknesses, opportunities, and threats. That is more traditional terminology perhaps than is currently used, but it includes the element of thinking of what's out there that might threaten us, harm us, how would it harm us, and what are we doing to watch that risk? And secondly, do we have a plan to address risks if these things come to pass? And then finally, the board has a responsibility to monitor not just the finances, that's clearly the piece we're focusing on today, but to monitor the progress that the organization is making towards the goals and priorities that the board has set for them. So that's the board. Within most nonprofits, the organizational structure is the members elect the board, and then the board engage a CEO, chief executive officer, executive director, general manager. Terminology may be different, but the board generally has one senior employee that reports to them. And so the executive director or CEO, I'll use the term executive director for this course, but you might be more used to president or CEO. But the executive director then has the responsibility to keep the board apprised of what's going on in the organization. And so I haven't listed the executive director here because they're kind of not hands-on necessarily in the financial process. And so I'm assuming that you understand the role of the executive director in providing a connection between the board, the programs, the financial reporting, and so on. They're kind of the hub of all of that communication. So many organizations, in fact, most bylaws of nonprofits require the appointment of a treasurer. And so the treasurer role may be filled by a single individual that is appointed by the board. In some cases, the board appoints either a finance committee or an audit committee or a blended audit and finance committee that fulfills the functions of what in other organizations the treasurer on their own fulfills. So where I say treasurer, that might be a committee as opposed to an individual. But in any case, the board doesn't necessarily have the expertise or the time to spend a lot of time on the details of financial matters. So there'll be somebody that they appoint on their behalf to act as sort of their eyes and ears when it comes to finances in the organization. So the treasurer, or as I said, the finance committee, may advise the board, they may advise management, and hopefully you have a job description for the treasurer so you know whether that role is primarily to advise the board or primarily to advise management. Different organizations structure that role differently. And so it's important that you and your treasurer understand what their role is in the organization. Who do they report to, and who do they report on behalf of? And so the treasurer or the finance committee will convey financial information to the board, which may be creating and providing information, or it may simply be commenting on financial information that's been provided by the executive director. So there's, again, different ways that might happen, but they do have this liaison role. And then the other thing that's really important, and again, if you have an audit committee, it would be the role of the audit committee or the audit committee chair. If you don't, then it might be the role of the finance committee chair or the treasurer, is to provide a liaison between your external auditor and the board. So the external auditor, while they on their day-to-day preparing the audited financial statements or doing the audit, their main communications is with management and with the accounting staff, but they have a professional obligation to communicate directly with the board. That is not something that the CPA can avoid doing. It's part of what we have in our professional obligations, that we have to have a link to the board. And very often that link is the treasurer. And then, of course, the treasurer also has a role in ongoing monitoring of the finances. And then the last direct involvement is your accounting department, your accounting staff, bookkeeper, whoever does your actual financial record keeping. And that might be one part-time person, a contractor. It might be a whole department of, half a dozen accounting staff. So really depending, again, on the size of your organization and how complex your accounting system is. And so the bookkeeper or accountant does not report to the treasurer. They do not report to the board. They report to the senior management, to the executive director. And so even if it's a contract position, it would be quote unquote a staff role, not a board or committee role. And so the bookkeeper, enters the transactions, balances the bank, does all of those kind of things, and then provides the financial reports to the executive director and or to the treasurer to be then summarized and conveyed to the board. They also usually have a role in the audit process because there may be detailed questions or requests for specific accounting documents that the bookkeeper will be able to provide. And again, they have a role in the ongoing monitoring in the sense that they're usually responsible for doing a monthly bank rec. They may be responsible for doing T4s and other government reports. And so they have to keep an eye on what's happening in financing. So those are the three broad categories of roles within the nonprofit, excuse me. So I'm going to be using the terms treasurer, board, and accountant in today's session, realizing that you may have different terminology or different titles for those different roles in your organization. So what kind of financial information does the board need to start off now? I think they want information that helps them figure out where are we now, so a snapshot in time of where things are financially. They want to be able to predict where are we going? Do we have the resources to get there? And then finally, to fulfill those fiduciary and trust responsibilities of planning and then monitoring whether our plans are happening. Are these decisions being put into effect? Are they being put into effect wisely? So they have a role in planning and monitoring that also requires financial information. So let's look at some of the kinds of information that they might use for each of these pieces of their responsibility. So for that snapshot in time, for the board to see where we are now, these are some of the typical types of reports that would be provided. So a statement of operations, I think you're all familiar with that. In a business, it might be called an income statement or a statement of earnings or something like that. In a nonprofit, it's generally called a statement of operations. So it says, this is the revenue that we recognized in the period. These are the expenses we incurred in the period. And so this is what our surplus or deficit was for the period. What the statement of operations tells you, it's often prepared in comparison to the budget. So the board can see whether their initial business plan that they approved is being achieved, is being complied with, whether the priorities that they said should have resources devoted to them, whether we're actually spending the money on the priorities that the board has set. So those are the kinds of information that the board would look at on the income statement. Now, on the statement of operations, I want you to note that I said at the beginning, it would indicate the amount of revenue recognized in the period. I did not say the amount of revenue received in the period. And so the amount of money or revenue that you receive in the period, some of it may be for a future period. And so in the period, you only recognize that portion of the revenue received that's related to activities that you completed in this period. So let's say that you're doing a quarterly report. You received an entire 100% 12-month grant at the beginning of that quarter. And so let's say you got $100,000. It's going to last you all year. You're reporting on quarter one. If you reported $100,000 of revenue, it will go, wow, we've got a huge surplus. But in fact, only $25,000 of that grant relates to quarter one. And so the normal accounting is that the statement of operations would only recognize that portion of the grant that relates to the current period. And the difference is reported as restricted cash or something called deferred contributions, if you're familiar with that term. And so it's basically on the balance sheet, setting aside the $75,000 that relates to quarters 2 to 4 and saying, okay, we have an obligation to the funder. If we stopped operations today, we would have to pay back that $75,000. But if we continue into quarter 2, we get to spend another $25,000. And so it's important that the board understands not only how much revenue was recognized in this period, but how much revenue have they received for which they have an obligation to deliver on behalf of the funders. And that's captured on the balance sheet and by focusing on the deferred contributions. So those are the pieces of the puzzle that help the board see this is where we're at today with respect to what we've accomplished in the most recent period and what our obligations are for the next upcoming period. Another set of financial decisions and financial information that the board needs is information that helps them see where they're going, not just where are we today, but where are we going to be in 3 months, in 12 months, and 5 years. And so the outline of that plan comes with the preparation of a strategic plan or a long-term business plan, setting of priorities. There's different ways and different terminologies that is used in practice, but basically looking ahead and building that long-term roadmap. And so that's sort of one of the first things where the board says, this is where we want to go. This is where we intend to go. This is what's most important for the future of our target clients, our what we want to accomplish in this world. Another looking forward type of plan that's important for an organization that owns a lot of assets, perhaps you own a building or you have significant expensive equipment that you're dependent on. It's important to also know what the life cycle of those capital assets is. And a very good illustration that most of us are familiar with are condominiums. So if you are familiar with how condominiums work, our condo fees partly go to fund this year's operations, keep the snow off the parking lot, keep the hallways vacuumed and so on. But a portion of the condo owner's fees also go into a reserve because someday the roof is going to need to be repaired or the boiler need to be replaced, and you don't want that to come up as a surprise. You need to plan ahead. When are those big expenditures going to come up? And are we setting aside enough money to be able to meet those obligations when they occur? So the capital life cycle plan is primarily a need for boards that have a lot invested in capital assets. It's not for all organizations. Another thing that I recommend is that the board not only look, sort of that 5-year strategic plan, and not just focus on this year's budget and this year's cash flow, but also look ahead a couple of years. So if we have some projects, pilot projects that we're doing, how long are we going to be able to sustain them? You don't want to suddenly come to the end of the year and say, oh, well, we only had a one-time grant to do X and Y. And now we've got to tell our clients, sorry, we only had a 1-year grant. So you want to look ahead. Is what we're doing today sustainable for multiple years, or are we going to have to find replacement revenue or find a way to wind down a particular project? And so that questions often not answered by looking only at the current year's cash flow or the current year's projections. You want to look ahead at least a couple of years and know that your funding is sustainable. And then the most narrow where are we going question is that current year, current period, budget to actual. We budgeted that we would spend, $500,000 on program A. We're halfway through the year. We've already spent $275,000, which is more than 50%. So management, what are you planning to do with respect to the fact that we're over budget? And management may say, well, this is a program where there's a lull in summer. So yes, we spent more than half the money in the first half of the year, but for the next 2 months, we're basically on hiatus. So we've done more than half of our activities. So that's why we've spent more than half of our money. And so that's more of a short term, where are we going question. Are we going to make it to the end of the year within our basic plan? The third category of decisions and responsibilities that a board have that uses financial information is planning ahead, as well as monitoring our decisions that we made in the past to see whether those decisions are being implemented and if the results are as we expected. And so the key beginning piece of that monitoring is comparing actual to budget. And so there's different ways of doing the actual to budget. My preference is to say, what is our actual year-to-date revenue and expenses? What is the forecast for the rest of the year? And then compare that to the annual budget. Other organizations say, okay, it's the beginning of quarter, or it's the end of quarter one. What is our quarter one actuals? What was our quarter one budget? And if your activities are fairly constant throughout the year, then doing a year-to-date actual to a year-to-date budget makes sense. But if there is some seasonality to either your revenue or expenses, I think it makes more sense to do that forecast and compare it to the annual budget as opposed to a part year budget. What's really important when doing that comparison then is figuring out why there's variances. So some of those variances may just be timing differences of when particular events happen. So if you have two big donation campaigns every year, then your revenue is going to come in chunks. It's not going to come in nice and neatly, 1/12 per month. So the variance explanation may be this is just a timing difference. We're still on track. Or it may be, well, we didn't realize that utility rates were going to double in the period. And so that's why our facilities costs are so high. Well, then the next part of that is, well, what are we going to do about that? And so again, that's somewhere where management would tell the board, yes, we see that utilities are over budget. It was non-controllable. It was rate changes. And here are the steps we're taking to find savings in the future to make up that difference. Or we have identified some potential sources of new revenue that's going to help us make up that shortfall. But not just saying, oh, here's a variance, but also what is management doing about the variance? Sometimes that variance explanation is done on an exception basis. So management may only be asked to provide explanations and responses where variances are, more than a certain dollar amount from the budget or more than a certain percent. The exceptions may be defined by budget category or based on the bottom line. So there's a lot of different ways that exception reporting can be designed, but you don't want the board to focus on minute variances. You really want them to focus on variances that reflect changes in plans or are going to require changes in plans. And then the last thing, but maybe the most important, is the looking at the budget to actual may help the board have some insight into whether their plans and priorities are being carried out. So for example, we have program A and program B, and we wanted for this year to really, and just the example I often use, and some of you have been in courses I've taught before, is an organization that provides services, mental health services to children and mental health services to adults. And so the children programming is in the nature of providing support for schools in the event of disasters and so on and so forth. The adult programming is counseling services one-on-one. And so perhaps the board said, we really want to focus on expanding the work we do with children. Well, when you look at the current year's financials mid-year, the board may see, well, you haven't spent an extra dime on children's programming. You're still spending 75% of our funds on adult programming, and we wanted to prioritize children's and do some new initiatives with schools and children. We don't see any money being spent on that. What's happening? And so management's response may be, well, we've got some initiatives coming up that are going to happen this fall, or they may say, we did these initiatives, but they were carried out by volunteers, so there was no financial implication. So the financial information may not necessarily answer the question of whether our plans and policies are being carried out, but it gives the board the opportunity to ask about it. So that is kind of the three areas of board responsibility where they may use financial information. Where are we now? Where are we going? And helping us fulfill our fiduciary responsibilities. So financial controls, that's what the whole topic of today is about. So I just want to stress that when we're talking about internal controls or financial controls, the main purpose of controls is to enable management policies to be sure that they're being implemented without somebody having to look over your shoulder all day, every day. So you put processes in place that will increase the likelihood that policies are being implemented as intended. And those kind of purposes might be protecting assets from loss, mitigating risk, identifying where there is going to be risk and putting plans in place to make sure those risks are reduced. Efficiencies is a valid management goal in setting up controls, and then finally monitoring. So we're going to talk about sort of two general kind of controls. Most of my time is going to be spent on specific and application controls. So there are some that apply equally to everything and everyone that is within the organization. And then there's some very specific things related to specific steps we do in the financial processes. And keep in mind when I'm talking about, I'm not going to be identifying them as such, but just keep in mind when you're looking at each of the controls, is this something that is going to prevent errors from happening? Or is this something that's going to detect errors that have happened that now need correction? And then there's another kind of category of controls that are separation of duties. That's where there is a process in place and there's more than one person involved in the process, so that somebody isn't doing an entire process from beginning to end without anyone else being involved. So the general or entity-wide controls are things like knowing your people, vetting volunteers and new employees by some process, getting their CV, checking references, and so on and so forth, bringing in new volunteers maybe to work in an event or a committee before inviting them to the board. So knowing your people and making sure that you're getting people into your organization to share your values. Another really, really important area of entity-wide controls is that organizational culture. So it's not, I can't say how many times I have heard individuals say, managers say, well, just break the rules this one time. And they may not put it that way. So, you know, an accounting staff or a different employee in the organization will say, well, we have this policy, I have to get this signature before I do this. And, you know, maybe pay the chair's travel expenses or something. And the executive director says, well, you know, it's the chair, pay it. Well, we need, you know, a second signature. And so the organizational culture may be, yes, these policies are important and we're going to stick to them, or it may be, oh, we'll make exceptions for important people. And so that sends a signal then to the rest of the organization that these controls are really not that important because they can be breached for specific individuals or VIPs. And that sets tone at the top of controls being unimportant. And then the other set of policies that are really important in defining that tone at the top is having value statements, code of conduct, that not only the board, but the entire organization is expected to ascribe to and be aware of. Having a whistleblower policy so that if there are concerns at the lower level among volunteers or staff about things that are going on that they think are not appropriate, that they have a chain of communication, that they know who to bring those kind of concerns to. So those are the broad entity-wide controls that every nonprofit needs to have in place. Some of these are embedded in board policy. So if you have a board policy manual, that's where some of these controls are documented. The rest of the topics that I'm going to talk about are more specific. And so they fall into these broad categories of bank reconciliations, purchase approvals, how you handle deposits, and so on. So let's look at each of these 6 categories separately. Before we talk about controls around banking and revenue, I just want to make sure you understand the difference between some of these different types of revenue mechanisms of getting in revenue. So you can get cash, obviously, that's not very common anymore, but you may have sort of a cash drop box at an event where people want to make extra donations, or you may be selling merchandise or something that people pay cash for. It's becoming less common, but it still exists. Checks are becoming less common, but you still get a certain amount of checks in for either grants or donations or whatever. Electronic funds transfer, the next 4 I want to talk about. I should have put pre-authorized debits as something altogether different, but EFTs, e-transfers, and wire transfers are 3 different variations on the same thing. So EFTs are more formal, and there's good controls over electronic fund transfers at both the initiators end and the receivers end. So those are generally not subject to as much abuse as e-transfers. Wire transfers are a specific type of EFT that is more commonly used if you're doing transfers between countries, or if you're doing sort of a one-time or receiving a one-time large payment, as opposed to whereas an EFT is an arrangement that you generally have with regular vendors or regular customers. E-transfers, I want to talk about e-transfers at this point rather than address it on a later slide. This is when somebody can send you money by email. And so in our personal life, we're all familiar with that. We have, somebody organizes a weekend trip for a group of friends, and we pay our share by emailing a payment to the person who organized it or whoever paid the hotel deposit or whatever. What we found at the beginning, and I'll tell you, I used to be an auditor. What we found at the beginning of COVID, the amount of donations being received by email transfers escalated significantly. And even before that, we had been advising clients to not accept that kind of payments, or to reduce it to the extent possible, because it's very, very susceptible to both fraud and error, and it involves a lot of manual work on behalf of the person who is doing the recording of the payments, because they have to look up who is this from, what is it for, and every single payment is a separate entry instead of having a batch of entries. And most organizations would, if they're accepting payments by email, would have automatic deposit set up. So when an email payment comes in, it automatically goes into the bank account. But quite frankly, someone who has access to the bank account, which many accountants and bookkeepers do, can temporarily turn that feature off. They may control the email account to which it comes, and then they can divert the payment to their own personal account. And you may go, oh, no one would do that. In fact, people do that not infrequently. So if you can discourage e-transfers and replace it with either pre-authorized debits and credits where you withdraw from the person's account as opposed to them initiating it, or EFTs is much more reliable. And I even find credit card payments, even though there is a fee attached, I consider whether that fee is there's a benefit to it in spite of its cost because of the greater security than what happens with the e-transfers. So here is, even if I stopped the session after this, this is the number one control that I recommend in all organizations, but particularly in small organizations, is figure out who is going to be doing the bank reconciliation. Normally, if you only have one person doing the accounting or bookkeeping, it would be that person. But if you have multiple people in your accounting department, think carefully about who does the bank reconciliation. It is the hub around which most financial controls operate. The bank reconciliation process is important because all transactions eventually have to go through the bank. So yes, I understand that there's payables and receivables, and there's revenue that's recognized that's not cash, and you have amortization expense and that's not cash. But at some point, all of those transactions went through the bank account. And so by focusing on having a regular, timely bank reconciliation done, errors are caught more quickly, misstatements are caught more quickly, the accuracy of your accounting records is more reliable. And what I think a lot of organizations skip is what I think is the most important final step of the bank reconciliation, is to have a second person review it. So it's not just somebody does it and puts it in a file or saves it to a folder, but that a second person reviews that. And that second person, when they review it, should have a copy of the bank reconciliation for the period, the prior period's bank reconciliation, so they can watch things being carried forward from month to month, and a copy of the bank statement on which the reconciliation is based. So those three documents should be presented together to the person doing the review. And then the review should be documented, and you can do it in different ways. If it's a paper thing, initialing and dating, yes, I've seen this and I've checked all the numbers, or an email saying I have reviewed the bank reconciliation as of such and such a date, and then that is saved as evidence that the treasurer or a second person or somebody has reviewed the bank reconciliation. That's a really, really important control. I can't stress it enough. The controls that we think of most often when we think of internal controls is around approving purchases. And so what's important here is not so much what those policies and processes are, but they're clear and understood by everyone, and that they are followed by every party in the process. And that those policies don't change from week to week or month to month, or from one department to another or one person to another. Normally, if you have a program manager or a mid-level manager that is responsible for preparing their budget, they should also have permission to approve purchases within their budget. And I would recommend that the person approving also do or check the coding to make sure that the expenditure is coming out of the intended budget line. And then the last point I want to make, and not belabor, is that approving a purchase is not the same as approving the payment of it. So approving, yes, this expense happened, we received this merchandise and it came okay, I approve this being coded or charged to my budget. That doesn't mean that the person who's issuing the checks can now immediately issue the checks, because that's a cash flow decision. So you need to make a separate decision as to which payables you're going to pay this week or this month or on this cash run, this check run. So approving it by that program manager, that's approving to record the payable, and then somebody else or at a different stage will now approve payment of it. Just keep those separate and don't assume that they're the same thing. Controls over deposits and revenue will include things like if you're getting money in by cash or check, how often do you make deposits? Is it when take it to the bank? Is it when it gets over a certain dollar amount, or is it a certain frequency? Again, a lot of organizations used to do that daily, but now so much happening digitally, a lot have switched to weekly or when the amount on hand exceeds a certain balance. Dealing with e-transfers, I've talked about briefly. So the controls that I would recommend if you are receiving email transfers by email is that you designate a specific email address, that all payments have to go to that email address, and two persons should have access to that email so that one person can't, like I said, divert any of the deposits without another person seeing that it's come in. And if money is sent, so let's suppose we have an email address, donations at Stella Penner. And so everybody sends their donations to the donation account. And then one day somebody doesn't realize it, so they send a donation to Stella at stella.penner. And you get this email, somebody has sent you this money. If it had gone to the donation email address, it would have gone straight to the bank. But because it's coming to a different address, it will now not be automatically deposited. So the answer to that then is to communicate to the person and say, I'm sorry, I cannot accept this. Please use donations at to make this donation. So that's recommendations that we make. And then again, dealing with who did the money come from and where is it supposed to be allocated can be quite time intensive. So there needs to be some clarity of who's going to do that, what kind of research are they going to do before they record the transfer. And then a separation of duties. Again, you want probably, if possible, that the person that does the recording of the revenue transactions is probably not the best person to also be doing the bank reconciliation. If you have a large enough group of people, those are two responsibilities that I would separate to the extent possible. Specific application controls around hiring and payroll is document changes. So you want a clear documentation process of when you hire people, maybe an intake form that says this is a person, the day they started, all of their information, here's their TD1, here's all their banking information, whatever you need, here's their approved rate of pay, their hours of work, and so on. And that goes to payroll. So if you have a separate HR department, that does, probably they're not doing the payroll, probably payroll is actually being processed in accounting. So you need to have a clear line of communication of what information is given to the payroll preparer, and it should be in writing. And this is not the same as the person's personnel file. So the person's personnel file would have things like evaluations, job descriptions, and so on. And the person preparing payroll might not have access, or maybe shouldn't have access to that. So this is the actual hiring details that the payroll person needs to set them up in the payroll system. You want any approvals of changes in pay, changes in terms of employment, should be, again, in writing. and approved by the person's manager and or HR, depending on what your policy is. And I also recommend, especially in small and mid-sized organizations, to use an external payroll service. I don't have any vested interest in them. The ones that you're probably heard of the most often are Ceridian, ADP, Payworks. Any external service like that adds a level of control and accuracy, as well as I think it's great cost benefit as far as like preparing ROEs and T4s and so on and so forth, reduces the amount of bookkeeping effort required. And so those are some of the controls around payroll. And you, of course, want controls around hiring, but I talked about that in entity-wide controls, processes like checking references and, having people sign an agreement on the confidentiality and the code of conduct acknowledgement when they get hired. But this is more specific on payroll. And then another set of controls you want is around financial reporting. You want to make sure that the internal financial reports that are going to department managers, to the executive director, and to the board are accurate. So you want some sort of a timeline of when these reports are prepared, which adjusting entries are made before the reports are prepared. Does somebody check the reports before they get distributed to make sure they're accurate? If there are questions about the reports, where are they directed and who's responsible for answering them? Those are the kind of controls and processes you would want over internal financial reporting. And then for external financial reporting that is going to funders, to donors, and to lenders, again, you want maybe even a second level of review, making sure that the reports that are going to these outside stakeholders comply with the terms of your agreement. So specific program funder, for example, may not be asking for your organization's financial statements. They may want a separate report for just their program. And so whoever is designing the external reporting needs to be aware of that, needs to know when is it due, does it need to be audited by your auditors? So all of that, you need to have some sort of a log or diary that's available to people in the accounting department and management, knowing what external reporting obligations do we have, who is responsible for it, who is going to prepare it, who is going to check it and approve it before it goes out. And then regulatory compliance. I've just tacked this on the end, but it's really quite important, as you can imagine. So some of the things, regulatory compliance, I've included program reports here. These are more contractual reporting requirements rather than regulatory, but at the same time, if you have signed contracts with agencies who are funding some of your operations, you need to have this on your list of what reports do they get and when. And oftentimes when you have government agencies funding programs, there are two types of reporting you do to them. One is on outcomes. And so that would be the program staff saying we served so many meals, we had, so many, so many beds were occupied, if we're, a shelter or something like that. So a report on outcomes is different than a financial report. So one is what did we achieve with the money the agency gave us? And then the second is how did we spend the money? On what did we spend the money? And so just distinguish between who's going to prepare and are they going to be coordinated? Is the finance group going to coordinate with the program staff in getting those reports in concurrently and making sure that they're consistent and don't contradict each other? Tax filings, depending on whether you're a nonprofit or a registered charity, you may have to file a charities return, which is a T3010. If you're a nonprofit that's not a registered charity, you may have to file a corporate tax return and nonprofit information return, also referred to as a T1044 in Canada. And so again, know what tax filings you have to file. T4s, obviously, ROEs for people that are leaving. Somebody needs to have a master list of here is all of our filing obligations, when are they due, and who is responsible for making sure that they happen. And then other filings that are not related to tax may relate to your corporate existence. So in Alberta, if you're incorporated under the Societies Act, you have to file an annual societies return that includes your financial statements and a list of directors. The due date for the annual return for a society is not the same as when your charity or tax returns are due. The anniversary date of your initial incorporation determines when this is due. It's not your fiscal year end. And so just be aware of when those due dates are and have a calendar that someone's monitoring to make sure that those things happen. And if you're in Alberta, I did look at the registration list. I think the majority of the group is in Alberta. So there's two main or three main legislations under which you may be incorporated. There's the Societies Act, which I've mentioned. There's the Alberta Companies Act. You can incorporate a nonprofit company under that. And so that would have different filing requirements than Societies Act. And then you might be registered under the Canada Nonprofit Corporations Act. And those requirements are even more specific. So under the Canada Nonprofit Corporations Act, you need to include audited financial statements unless you're really, really tiny. Under the Alberta Companies Act, you need to have audited financial statements if your revenue exceeds $1 million. So again, know those different filing requirements depending on the legislation under which you are created. And then the last thing I mentioned, this a bit of a tag on, is how does budgeting fit into this whole area of controls? And I wanted to put this slide in to acknowledge that not everybody, organizations have very different philosophies and purposes of how and why they use budgeting and how and whether it's used as a control. And so the first thing I want to stress is budgeting is a form of planning. And so if it's done right, the most important contribution of budgeting to financial controls is that it forces the organization to plan ahead. So you're not always in reactive mode. So it provides that opportunity to look ahead. And I've had organizations that say, well, we're so small and we're so simple, we don't need to do budgeting because we know kind of what's coming in and what we're going to do. And if it doesn't come in, we won't do X or we won't do Y. But I would say then if it's that simple, then it's no trouble to prepare the budget, right? So why not do it? So an ideal budget approach, I would say, is first, let's say, what are our priorities for the next period or year or 2-year or whatever period we're budgeting for? What activities are we going to do to achieve those priorities? Where is the revenue coming from to fund those activities? And lastly, how much is it going to cost to do those activities? So a lot of people approach that differently. They start with saying, what are we going to spend? And I say that is the fourth question. So the final question should be, what are we going to spend our money on? It's not the first question. So what are our priorities? What are we going to do? And what is it going to cost? And then if those don't match up, then you go around to the beginning of the process and reiterate until you get your revenues and your planned activities in sync. And then use your budgets then to monitor your activities throughout the year. So just to recap where we've been, do you know what your role is? I talked about the board, the treasurer or audit committee, finance committee, and the accountant or bookkeeper. If you know, do you have a job description? Do you know what the other people in the process are expecting of you? What are they entitled to expect of you? And what are you entitled to expect of them? So understanding roles and responsibilities is important. I recommend job descriptions for each role in the organization. And then, does your board get the financial information they need? Do they get it as often as they need, and not more often? A lot of times organizations get monthly reports, where I think quarterly would be sufficient. So really think about that, because if you provide it too much detail and too often, people's eyes tend to glaze over. Do you have some basic financial policies and controls in place? You can go back, look at the list and some of the examples I provided, and see, well, what are we doing in this area? Or do we have gaps over here? And then lastly, are you using budgets effectively as a planning tool as well as a monitoring tool? So that would sort of be the questions that I hope you'll go away and ask about your organization as you leave the session. And Liz, do we have time for questions? I don't have a Q&A slide.
Well, we really didn't have questions that came in through registration, but I think it's probably more helpful for folks to know what's coming up. So we'll keep going to that. So if today's session sparked any sort of areas that you might need development in, or maybe you're interested in some more in-depth information specific to your organization, we as a nonprofit ourselves do free helpful conversations or clinics. And so what those might look like would be a short phone or video conversation, or it could be a more in-depth 1-hour problem-solving session called clinics between one of our IntegralOrg experts, sometimes Stella is there, and your team. So yeah, that's just part of our mission to support nonprofits like yourselves. And so you can find out more about this free service by visiting our website or contacting us through admin. And upcoming, I know we touched a little bit, if we go to the next slide, we touched a little bit on some budgeting things, but we will go more into it in about a month. Stella will be hosting the budgeting webinar once again, and we have a sliding scale ticket pricing to hopefully make it more accessible for some organizations that are just getting started. And in the world of money still, we have Intro to Fundraising, which is another session like this that's free, and it's an hour, and it's sort of more of an energetic overview of the basics of fundraising. Yeah, and perhaps also after the session, maybe you're considering taking some of that back of the office sort of demand off of your desk. So we have some friends at Access Shared Services. They're also a nonprofit, and they offer accounting services kind of from a collective of service providers who are really accustomed to the nonprofit and charity world. We have one question in the chat, which is, how would you suggest a contractor proceeds for a new nonprofit where administrative infrastructure is only just being developed?
If you don't mind asking your question in person.
Yeah, absolutely. So it's a brand new nonprofit, and we're tasked with setting up the administrative and financial infrastructure. And so there's already money kind of coming in now that the bank account is open. And so as a separate contract, we're managing the bookkeeping as well as developing the infrastructure. And so a lot of this is different from my past experience in charities,
right?
Because it's a nonprofit and not a charity. And so there are some differences. And so, yeah, I mean, we're already kind of in the process, but what kind of things to focus on?
So one question I have, is it a member-based nonprofit? What is sort of the primary source of the revenue?
The revenue so far has been for a specific project that started.
So like a grant type of thing.
Yeah, they were kind of fostered by as a program of other organizations for a time, and now they have a specific project that they're developing.
Yeah. So the reason I asked about members is if it was a member-based organization, like a like CPA, whatever, professional organization, then a really important thing is keeping of your infrastructure would be a member roster and knowing who your members are and have they paid their fees. But if it's not, then we'll put that aside. So presumably they have a bank account. So you need to, I'm going to focus on the accounting side for now. You're going to need to have, of course, a general ledger. You're going to need to know when is their fiscal year end. I would suggest you want to read through their articles of incorporation and bylaws and just see if anything jumps out at you that is required, know what their fiscal year end is. Work with their executive director or treasurer, if they don't have an ED, to develop sort of a template of how the financial reporting is going to look at year end so that you can set up a chart of account that's meaningful. And that's kind of, a lot of things will fall out of that financial reporting. And then if you have a contract with whoever's funding the project or program, get familiar with the financial reporting and non-financial reporting requirements there, and think along those lines, like how are we going to monitor the information that we need to report to the main funder? And that will start answering your questions, I think.
Okay. Should the treasurer in that case be a CPA?
No,
or have a strong financial understanding at minimum?
I think they need to be financially literate. A lot of business people I know that are not CPAs have years of experience reading financial reports and financial information. So I don't have a strong view on that. I'll just tell you, it's not, yeah.
But they should be financially literate. They should understand.
They should be able to read a financial report, yeah, and understand the significance of, like the difference between a balance sheet and an income statement kind of thing.
We wish you luck on that, Sandra.
I'm just not going to add anything more.
No, I'm going to sign up for those
the budgeting one.
The clinics, because that'll probably give me a little more time to get a real good.
Yeah.
Great.
Well, and you may want to book a clinic. If you book the clinic on that topic, it's quite possible that I would be the clinic leader.
Mm-hmm.
Okay.
And if you want to do like a phone call first, and we can explore this a little bit more specifically with regard to your organization, and then figure out who to include in a clinic later.
Mm-hmm. Mm-hmm. So admin would be the best contact for you, Sandra.
Okay.
Or you feel free to email me as well, because we're going through an admin transition. So anyways, we did have one question. It's a kind of a quick question from registration I'd like to address. But it's, should check signing authority limits be included in a financial policy or the bylaws? And I can copy it into the chat.
If you're talking about limits as in, below X dollars, one signature, above X dollars, two signatures, or that kind of limits, I would not put those in the bylaws.
Okay.
I would put those in policy, because those change as it's so hard to change bylaws. And if the organization grows, that may become outdated. So I wouldn't put it in the bylaws. But it does make sense to have it in a policy, which is more, the board can change those annually as situations change.
Mm-hmm. Okay. Wonderful. I mean, those are all the pressing questions that we have right now. I'd just like to thank everyone for your time. I know we went a little bit over, but I hope all the information that we presented today was helpful. And then if you do want to review any of it, I will be sending out the recording. It should be ready and posted tomorrow, but I'll send an email reminder on Monday. And that's pretty much all for me. Thank you. Also, thank you again, everybody. Stella. Yeah.
Yep. I'm glad to meet you folks. I'm sorry I didn't have my camera on. I didn't get to see most of you. But I do have a general sense of who is in the group. So good connecting with you, and maybe we'll talk to you in a future clinic.
Thank you, everyone.